the next topic is revaluation of assets and liabilities. The assets and liabilities of the partnership firm has to be revalued at the time of the admission of a new partner. Some assets or liabilities value may be increased, some assets and liabilities value may be decreased. The purpose, why they prepare the revaluation account? In order to prevent the new partner to get a share in the appreciated value of the assets and not making him to suffer because of depreciation in the value of the assets. So, he is a new partner. He neither enjoys the profit nor suffers the loss which is made in the firm before the admission of that partner. That is the main purpose. The changes in the value of the assets and liabilities are recorded in the revaluation account. The other name of revaluation account is profit and loss adjustment account. The profit and loss adjustment account or revaluation account will be transferred the net result, okay, the net result of the P&L adjustment account or the revaluation account should be transferred to capital account of the old partner in their old profit sharing ratio. So, the new partner doesn't have any role here, okay. He never gets a share in the profit, like that he never suffers a share of loss of the revaluation account, okay. The revaluation account profit or loss will be transferred to old partner's capital account in the old ratio. These are the journal entries of revaluation account. First, when the value of assets are increased, asset account debtor to revaluation account. Opposite, when the value of the assets are reduced, revaluation account should be debited, asset account should be credited. When the value of liabilities are increased, revaluation account debited, liabilities account credited. When the value of liabilities are decreased, liabilities account debtor to revaluation account. Profit on revaluation, that should be transferred to partners, old partners capital account in the old ratio. So, revaluation account debtor to old partners capital account. Revaluation loss, old partners capital account should be debited and revaluation account should be credited. These are all, in this way we have to pass journal entries to prepare revaluation account. What are all the items that should be credited in revaluation account? What are all the items that should be debited in the revaluation account? Let's see. The revaluation account is credited if the value of asset is increased, if the value of liabilities is decreased, unrecorded assets or income now recorded. Then revaluation account is debited if the value of assets is decreased, increase in the amount of liabilities, unrecorded liabilities now recorded, creation of new liability. Okay. So, these are all the credit items of revaluation account. These are all the debit items of the revaluation account. Actually, if the value of the asset is decreased, that is a loss for the firm. The profit of the old partners will be reduced and so it should be debited. If the liability is increased, naturally the profit of revaluation account will be reduced and so it should be debited. Unrecorded liability, new liability, or if the firm failed to record that new liability and now they recorded, that will affect the profit of the firm and so it should be debited. That will reduce the profit of the revaluation account and so it should be debited. Like that here, if the value of the asset is depreciated, then the revaluation profit will be increased. So, that should be credited. Decrease in the amount of liabilities. So, if the liability amount is decreased from 1000 to 800, then 200 rupees the firm can save, and so that should be to the extent of decrease in the amount of liabilities, the revaluation profit will be increased and that should be shared between the old partners in the old ratio. And they fail to record the assets and now they record, say for example 10,000 worth of asset they fail to record, now they record to the extent of 10,000, the revaluation profit will be increased. Okay, so that should be credited. So these are all the items that should be credited and debited in the revaluation account in order to find out revaluation profit or loss. This is the format of revaluation account. Here there is no opening balance. Just they are revaluing the assets and the liabilities and so there is no opening balance. So first debit side to assets individually decrease in value. We have to mention if the asset is decreased, we have to mention here individually. So the machinery value is decreased and then land value is decreased. Then we have to mention clearly, separately, individually we have to mention the assets which are reduced and how much it is reduced. Like that, by assets increase in value, sometimes the assets value may be appreciated. In that case, here we have to mention the assets individually and to which extent it has been increased. That also should be mentioned here. Then liabilities increase in value, unrecorded and newly credited. Separately we have to mention here if the value of the liability is increased. Like that here, if the value of liability is decreased, it has to be mentioned here in the credit side. And then this account will create either profit or loss. If the revaluation account produces a profit, the net result of revaluation account is a profit, then it should be transferred to partners capital account, old partners capital account in the old ratio. Like that, if the revaluation account produces a loss, that also should be transferred to old partner in the old ratio. So this is the format of revaluation account. Then the next one is a memorandum revaluation account. When revised value are not to be recorded. Under the revaluation account, the revised value of assets and the revised value of liabilities should be enter into the balance sheet. Okay, old values we should not consider under the revaluation account. While preparing the balance sheet, we have to consider the revised value. Suppose the building value is 1 lakh. It has been appreciated to 1,50,000. This 1,50,000 should be entered into the balance sheet. But when we prepare memorandum revaluation account, we have to record or we have to consider only this old value. So sometimes if the partner prefer to retain the old values in the books, although it is necessary to revalue the assets and liabilities at the time of admission of a partner, we have to prepare memorandum revaluation account. This is done by opening an account, memorandum revaluation account. It is prepared in 2 parts. If they want to retain the old value, they don't want to show the revised value in the balance sheet, then instead of revaluation account, they have to prepare memorandum revaluation account. So memorandum revaluation account has 2 parts. Let's see. The first part of the memorandum revaluation account is debited with losses on revaluation of assets and liabilities and credited with gains on revaluation, and any resultant profit or loss is transferred to capital account of the old partner in the old profit sharing ratio. Just like we have to prepare the revaluation account. That is the first part. The first part of the memorandum revaluation account is nothing but revaluation account. The second part of the memorandum revaluation account, all the entries made in the first part are reversed, and the P&L account, if the first part shows profit, second part will show loss, and vice versa. Of the second part will be transferred to the capital account of all the partners, including the new partner, in the new profit sharing ratio. So the first part is nothing but revaluation account. Then in the second part, all the entries in the first part are reversed, profit or loss. If the first part, the revaluation account shows profit, in the second part it will show loss. If the first part revaluation account shows loss, the second part will show profit. And the second part profit or loss should be transferred to capital account of all the partners, including the new partner. That is very, very important. Including the new partner in the new profit sharing ratio. So in this way we have to prepare memorandum revaluation account. If the partner wants to retain the assets, wants to retain the old values of the assets in their books, then they have to prepare memorandum revaluation account. Then if the books in the partnership firm, if there are any reserves or undistributed profit lying in the books, then it has to be distributed among the old partner in the old sharing ratio, because the new partner doesn't have any right to share the profit or doesn't liable to share any losses in the firm up to the date of his admission. After the admission only, he is liable for the liabilities and he can enjoy the profits of the firm. The entry is general reserve account debtor, P&L account debtor, any other accumulated reserve account debtor should be transferred to old partner's capital or current account. Here, the new partner doesn't have any role, okay? New partner account should not be credited with the general reserve profit or any accumulated account till the date of his, that is before the date of his admission. If there is any profit in the firm, that should not be transferred to the new partner, okay? Now let's see revaluation account problem. Hema and Lima were partners sharing profit and losses in the ratio of 4:3. In view of Seema's admission, they decided to revalue their assets and liabilities as indicated below. To increase the value of land and building 1,80,000. Provision for doubtful debts to be decreased by 2,400. Decrease machinery by rupees 48,000. Asset is decreased here. Furniture is also an asset that is decreased by 12,000. Then stock by 36,000. A provision for outstanding liabilities was to be created for 2,000 rupees 2,400. Prepare a revaluation account. Then this is the revaluation account. Okay, building value is appreciated to the extent of 1,80,000. Provision for doubtful debts is 2,400. Here the machinery is decreased to the extent of 48,000. Furniture decreased to the extent of 12,000 and so that should be debited. Stock is reduced to the extent of 36,000. Provision for outstanding liability is created to the extent of 2,400. So that the credit side total is 1,82,000. The difference is 84,000. This is a profit on revaluation account. This should be shared between the old partner in the old ratio. The old ratio of the old partner is 4:3. So 4/7 of 84,000 is 48,000. 3/7 of 84,000 is 36,000. This is the way to prepare revaluation account. Here you should remember one thing, very important one. The revaluation, either profit or loss. Suppose a revaluation account shows loss, that should not be transferred to new partner. That is very, very important. Only the old partner should get the profit, should enjoy the profit, and like that they should suffer the loss. There is no role here for new partner. We should not transfer either profit or loss of revaluation account to the new partner. Then the next topic is capital proportionate to profit sharing ratio. Sometimes on the admission of a new partner, it is decided that either new partner will contribute as capital an amount in line with his share of profit, or that the capital of other partner will be adjusted to make them proportionate to the respective share of profit. Okay. So here sometimes they make some adjustment. They take the new partners the capital as the base, and we have to make the changes in the capital of the old partner. Okay, so that definitely the old partner capital will be changed if we take the base as new partners capital. We are changing the proportion of the capital of the old partners, and we are considering the new partner capital as base. Adjustment of old partner's capital account on the basis of incoming partner. If the amount to be brought in by the new partner is fixed and it is decided that the capital of other partner will be in the profit sharing ratio, the amount brought in by the new partner is the starting point. On this basis, the entire capital of the firm can be determined and the capital of each partner is ascertained by dividing the amount according to their profit sharing ratio. Then question number 2. Adjustment regarding capital when new partner capital is given. A, B, C are partners sharing profit and losses in the ratio of 6:5:3. D is admitted into partnership and give him 1/8 share. He brings capital of rupees 14,700. New partner sharing ratio is new profit sharing ratio is 6:5:3:2. The capital account of the old partner to be adjusted on the basis of proportionate of D capital to his share in the business. Find out the capital of partners in the new firm. So there are 3 partners A, B, C, and their ratio is 6:5:3, and they admitted D, his share is 1/8. The new ratio is given, that is 6:5:3. He brings capital of rupees 14,700. You are asked to adjust the old partner's capital account on the basis of the new partner's capital. This is the capital calculation. D's share is, what is the D share? 1/8 he is given. For 1/8, he brings capital of 14,700. So the total capital of the concern is 14,700 into 8/1, that is nothing but 8, that is 1,17,600. A's capital in the new form, that is new profit sharing is given, that is 6:5:3:2. So 1,17,600 into 6/16, that is 44,100. Then B's share is 1,17,600 into 5/16 is 36,750. This is the B's capital. And C's capital is 1,17,600 into 3/16, that is 22,050. Then D's capital is already given, that is 1,17,600 into 2/16, that is nothing but 1/8 is equal to 14,600. So this is the capital of the firm, and this capital is reorganized on the basis of the D's capital. Sometimes if the A's capital, suppose A's capital is 30,000, he has to bring another 14,100 rupees. Suppose the B's capital here is the 30,000, then he has to bring 6,750 cash. Here, if the C's capital is 23,050, he has to return back 1,000 rupees. Okay, like that we have to make adjustments in the capital, and we have to consider the new partner capital as a base.